Hello, everyone, and welcome back to another episode. I'm your host, a Millennial Investor, and today is going to be a very fun episode. Today is an episode that I've actually been looking forward to making because today we're going to go over the basics of dividend investing through M1 Finance. We're going to be going over some information through the Fed, how the Fed is driving savers to riskier investments, how the Fed plans to hold its interest rates near zero through 2022. That's right, not 2020, not 2021, all the way through 2022, so at least the next 2 years. We'll be going over a couple earnings reports for a couple different earnings that I own. So we have 3M, that's up next. We have McDonald's after that. And then we have Altria. And this is great that I wanted to mention Altria because we'll be going over the news. But basically, we have a lot of companies that we see today that are constantly cutting their dividends, reducing it, slashing it to zero, whatever. The dividends in my portfolio are not only maintaining themselves, a lot of them are being raised, and Altria is no exception. Even though it has an 8-9% dividend yield, it is still raising that dividend. So a great company to own there. And then last but not least, one reason why I think my portfolio and my channel is about to start taking off wraps around to this comment that Omar left me about a week ago, and I wanted to bring this up in a video. So overall, guys, if you want to stay through all this in the video, thank you for joining in. If you don't know who I am, if you're new to the channel, my name is Jordan. I am the Millennial Investor. I track my annual dividend income, my monthly dividend income, and my portfolio value, as well as my YouTube income, which I will be updating at the end of this month in about a week. And if you're new to the channel and you have not seen my content before, if you'd like to support me for free, go ahead and use this link down in the description. This is a referral link for M1 Finance. You can get $10 just for signing up. And speaking of the description, there's lots of other content in the description outside of this link. So go ahead and check out the description and see if there's any other things in there that you're interested in looking at. And also, if you're new to the channel, go ahead and subscribe if you see value in my channel. But anyways, let's go ahead and jump right into it. And let's go ahead and start off by searching SPY, or the S&P 500, basically how the market's performing in general. You can see that the market is nearly at an all-time high. The S&P 500 is nearly back to its all-time high with everything going on, with shutdowns, with riots, with economic data coming in horrible, earnings misses. The stock market is flying high like never before. Now let's compare this to the Dow and the NASDAQ. The Dow is still quite a bit off, and this is a more realistic expectation of what it should look like. Now this is something that is still a little bit overpriced, probably in my opinion, but still, at least it's a little bit more down to earth. And then last but not least, we get to the great NASDAQ. The NASDAQ, it's gone parabolic. It's not even on the same level, and that's all because of these tech giants. You see, I made an entire video dedicated towards this. You see a lot of these ticker symbols prices, a lot of these big tech giants. You see Apple, how it's all the way to the sky. You see Google, it's all the way to the sky. You see Microsoft, it's all the way to the sky. Amazon, we can just keep on going. And all of these tech giants are absolutely carrying the market because they have such a large weight, and this is getting extremely unhealthy. But that said, if you're watching this video and you're new to investing, I want to focus on you guys right now. You see the market right now, and it's at an all-time high. And I want to tell you why you should be investing at any time in the market. You should be investing here at all-time highs. You should be investing here at all-time lows. You should be investing here now that it's recovered. Well, you should be investing every single week, every single month, regardless of what's happening. So I want to start off here by showing my dividend activity. We scroll here. I started this portfolio about 3 months ago. Those of you who know me, I started this channel the day that I started my portfolio. So I started this at the very beginning of April, and then it took a couple weeks to get my dividend started, and this is how it's looked so far. Now, when I started this portfolio, it was at $1,500. So today, we are exactly double that. We are just over $3,000. I funded the portfolio $2,375, and now we are just over $3,000. So a pretty big jump up there. Now let's go back to sorting by dividends only, and let's go to where I started off. And you can see how this really starts to add up. 48 cents, 55 cents, 62, 34, 11, 44, 34, 60, 48, $1.72, 20, 71, 139. Next, we go to the next page, and it just keeps on going. 45, 97, 17, 86, 61, 70, 66, 28, 36, 53, 38, 220, 94, 88, 55, $1.04, 71, $14, $60, and 43 cents. You can see how these really start to pile up in the long run. And you see how they're kind of going up. When you see the first page here, it really starts off with a lot of 40 and 50 and 30 cents. And now that we get a little bit further, you see the more recent activity. You see a lot more of them in the dollar. You see $1.60, $1.14, $1.04, $2.20 from Broadcom. And the real way that you can see this compound is the one company that I own that is strictly a monthly dividend paying stock, the only one that I own. So I actually receive a dividend like 3 days from now. It's actually for 74 cents from Realty Income. And you can see this growth from this one company. And now remember, I have 31 companies. 31 companies are growing their dividend every time they pay me. I reinvest back into their business, they raise their dividend, and Realty Income is a prime example from this. My first month, I only made 60 cents from them that month. The next month, I made 70. The next month, I made 71. This month, I make, I think it's 74. And then I believe the month after that, based off the shares that I own, I should make around like 85 cents. So you can see how the growth just gets higher and higher. So even though I only made 71 cents this month, maybe next month I'll make 74. Maybe a year from now I'll make $1.50. Maybe I'll make $2. The year after that, maybe I'll make $5, $6 a month. And you can see how this just keeps on compounding quicker and quicker. And if you're wanting to dividend invest, M1 Finance, in my opinion, is the best brokerage for this. One thing that I always like to do on my channel, I disclose all of my positions. I do not hide anything. I literally show everything on my channel. So many different YouTubers hide what they have, what they own. Maybe they recommend stocks and don't give their full transparency. Maybe they own it, maybe they don't. Maybe they show some of the losses that they take and maybe they don't. Maybe they just show the big gainers. But for me, I like to show every single stock that I own. I show every dime that I make from YouTube, and I like to disclose everything because it gives you guys that are newer investors a good idea of how the market is working. And speaking of being new to the market and getting started, how the Fed is driving savers to riskier investments. The Federal Reserve's efforts to buoy the economy and stabilize financial markets are working nicely for now, but we are in for a bumpy ride. The Federal Reserve is getting lots of love from the financial markets because it's lowered the short-term rates that it controls to just above zero. And it has figured out inventive ways to drive long-term rates to ultra-low levels and get some formerly troubled parts of the financial system working smoothly again. The stock market has risen sharply in the past 3 months, in large part because of the Fed, with the S&P 500 erasing most of the terrifying 34% 5-week drop that it suffered from its mid-February all-time high to its March 23rd low. But despite the benefits that our economy and stock market have gotten from the Fed, I've got a problem with the we're not even thinking about raising rates for the next few years policy of Fed Jerome H. Powell. Don't think a great stock market means we've got a great economy. So I want to address this. I want to give my opinion for this, how the Fed is driving savers to riskier investments, keeping interest rates at zero. And I want to jump right into this article because it goes hand in hand with what I wanted to mention here. The Fed is driving those people that have savings accounts at 0.0% annual interest are driving them to the stock market, whether they're in bonds, whether they're in the S&P 500, individual stocks, real estate. They're getting that money invested some way or another. And a lot of times they're going to the stock market. So let's look at long-term treasury bonds. Those of you that keep up with long-term treasuries, they went up to a negative interest rate. So literally the opportunity to get gains on a long-term treasury now is basically zero. You can see how these are sky-high prices. So if you're investing in them now at $103 a share, this is an ETF with all bond ETFs. So if you're investing in long-term treasury bonds now, where's your upside potential? Okay, it's at $103 a share now. Maybe if you're lucky, if it has a big spike up, maybe it goes to 110, 115 at the absolute most. But the downside potential is it could go back to the 90s, the 80s, the 70s. And I think in the long run, the stocks will always outperform the bonds. I'm definitely a believer in the U.S. economy and American businesses and basically just the American spirit and the American dream in general. You see that the stock market is recovering quite nicely here, and I'm sure eventually, it might take a week, it might take 2 years from now, eventually this number of 338, the all-time high for the SPY, is going to get blown out of the water. I believe that one day this will be 400, 500, 600, 1,000, 5,000. This will keep on going and it's not going to be stopping anytime soon. And speaking of how the Fed is driving savers to riskier investments, let's talk about interest rates for a second. Now basically the very general basics of interest rates is when the Fed lower interest rates, it's easier to get money. So if you're wanting to get a house and you're wanting to buy a house right now, instead of getting that house at a 3% interest rate, you might get it at a 2% interest rate. Instead of getting that car at an 8% interest rate from a loan, you might get it for a 7 or a 6, whatever. I'm just making examples. So basically, when they keep those interest rates low, businesses and individuals can get money easier. It costs less, and that incentivizes people to go spend money, which in turn boosts the economy, creates jobs, helps the government, yada, yada, yada. Now, the Fed plans on holding its interest rates near zero through 2022. The Federal Reserve said Wednesday that it would keep its benchmark interest rate near zero through 2022. Historically low interest rates can benefit those with good credit, but riskier borrowers are increasingly shut out. I don't really want to focus so much on the creditors, but if we see here how the interest rates have affected the markets through 2008 through 2023, you can see this chart here, and I won't go through it, but you can basically just read how the Fed had its back-to-back unscheduled decision. Unscheduled. So basically they had an emergency meeting and cut interest rates twice in the span of, what is that? So 12 days. In 12 days, they had two emergency meetings cutting it 150 basis points. That is a big cut. So basically, when you think about this, even though the stock market has recovered quite nicely, it's back near its all-time highs, we know that these companies are going to grow their revenues in the long term. And let's think of a lot of blue chip stocks. Let's think about your Coca-Colas. Let's think about your Pepsis. Let's think about a stock that we're about to go over in just a few minutes. Let's think about your McDonald's. All of these awesome, amazing, giant corporations that plan on growing their profits and their revenues every single year through buyouts of other companies, getting more profitable, raising prices, whatever the case may be, they're going to grow in the long run. And so these big blue chip companies eventually will have big weights on the market and will take the market up, so that alone will take the S&P 500 up. Not to mention we have dividend reinvestments, we have share buybacks, we have GDP growth, we have population growth. The stock market will go up in the long term, and the fact that interest rates are going to be at 0% all the way through 2022 gives it just one more catalyst. Now, the stock market can go down in the short term, but in the long term, this is just one more reason why the stock market will go up in the long run. So this is one more reason why the stock market going at all-time highs, why I'm saying you should also invest, and why you should specifically focus on dividend investing. If we go to my portfolio here, if you notice a trend, I own 31 companies. They all have something similar in common. And what is that? They all pay dividends. Some pay more, some pay less than others, but they all pay dividends. I believe the smallest dividend yield I own is Visa. It's a pretty high growth company, but even it pays a dividend of about 0.6%. So every stock that I own in this portfolio are paying me dividends to own them. Let's look at my largest holding here, Broadcom. I own it at a lot lower price, but even today, that price is actually off. If you divide $312 and you divide that by 13, the number that you will get is 4.166. So you're getting a 4.16, this number isn't updated right here, you can get a 4.16% yield on Broadcom. If you invest in my next largest company, if you go to Realty Income, you're getting about a 5% yield just to own it. You're going to make 5% annually regardless of what the share price does. They raise their dividends. Southern Company, you see a pattern here. The dividend yield is almost 5%. It just keeps on going like that. All of my companies pay me dividends, and most of them pay me at a significant amount. Pay me 3, 4, 5, 6. And one of them, like I'm about to go over, Altria, is paying me 8, 9% just to own it. Just to own it. So with Altria and a lot of these other companies, they have very high yielding stocks, and my portfolio is about double that of what the S&P 500 pays. And just to give you an example of this is why I focus more on annual dividend income than I do on portfolio value, because even when my portfolio goes down, it has uptrends, it has downtrends. Even though the stock market has pretty much went in a straight line up since we started, it has its little dips here. It has its little moments where it goes down, but this does nothing but go up. It's higher this month, higher the next, higher the next, higher the next. My monthly dividend income, you can see how I track every single company that I own here, and this is going to go up pretty much no matter what, talking about my annual dividend income. So I'm super excited about that, and let's go ahead and jump into some earnings reports, and let's start with 3M. 3M slips 3% after missing estimates, cannot forecast recovery. Strong execution and cash flow in an uncertain environment, reads a press release headline from 3M, but investors don't appear to be buying the news. Shares are off 3.2% in pre-market trade after the company missed both earnings and revenue estimates for quarter two. Adjusted earnings were $1.78 per share, a decline of 16.4% year over year, while sales fell 12.2% year over year to $7.2 billion, and organic local currency sales tumbled 13.1%. The company's operating cash flow was $1.9 billion, with adjusted free cash flow of $1.5 billion, contributing to adjusted free cash flow conversion of 149%. Due to the continued evolving and uncertain impact of the COVID-19 pandemic, 3M is not able to estimate the full duration, magnitude, and pace of the recovery across its diverse end markets with a reasonable accuracy. Therefore, 3M continues to believe it's prudent to not provide guidance. So basically, they're still withdrawing guidance through all of this. And then one thing I wanted to point out here. So you see how that is horrible news. 3M is putting up some pretty bad numbers. And I know it's because of recession, but there are some pretty bad numbers. You notice something here. Let's look at their earnings per share. Adjusted earnings per share was $1.78. Okay? And they paid out $1.47. But they made $1.78. So that means that they're still profitable. They're still having retained earnings. They're still able to reinvest back into their business. So this is fine for me. 3M is going to maintain their dividend. They did just raise their dividend again this year. And I'm not worried one bit about this earnings miss. And that makes me want to buy even more of the company. So next up we have McDonald's. So let's go ahead and type in their ticker symbol here. And let's see how McDonald's has held up through this recession. McDonald's revenue falls 30% despite progress at U.S. restaurants. McDonald's on Tuesday reported its quarterly revenue was slashed by nearly a third as coronavirus lockdown measures outside the U.S. weighed on sales for its French fries and cheeseburgers. While recovery in the U.S. has been comparably stronger, recent surges in COVID-19 cases have forced some states and cities to re-implement restrictions aimed at controlling the spread of the virus. As a result, McDonald's did not offer any forecast for its future performance. It also withdrew its guidance, and the shares are down about 2% pre-market. Now, if we go further here and we look at its earnings per share, 66 cents versus 74 cents expected, 3.77 billion in revenue versus 3.68, so a small little beat in revenue, but a small little miss in earnings per share. Now this is one thing that puts this dividend at risk. I think they're able to maintain it. I don't think that they're going to get rid of it or slash it, but they pay out $1.25 in dividends, but they only made 66 cents. So that is a huge red flag. That said, I know that McDonald's has raised a ton of capital. A large corporation like McDonald's, I mean, they have one of the largest investors in the world, Warren Buffett, not to mention huge names out there outside of him, but they can raise capital like they already have been in the snap of a finger. McDonald's is not a risky corporation. They can raise money, no issue, not one problem. And I'm kind of glad that this earnings did miss a little bit because this is going to take the McDonald's stock price below $200 a share. You're getting about a 2.5% dividend yield as of today, and they're due for another dividend raise in, so November, so just a couple months from now. So if they maintain that dividend, they're on track to raise it again. So let's see if they're able to maintain it. And this is one of those corporations, and with some of my corporations that I own, if they were to cut their dividend, I would sell them. But McDonald's is just one of those. If they were to reduce their dividend or even cut it to zero for a while, I would probably still keep McDonald's because they have an excellent management team and they're just a great company to own. And then last but not least, the last company that I'm going to go over is Altria. Altria is a stock that I own that is the highest yielding stock in my portfolio. It makes up a small 2%, and they have really lagged in share price. Even though they've raised that dividend from 57 cents up to 84 in the last 5 years, an 8% dividend yield. And let's go ahead and talk about Altria. A lot of the reasons why I cut my stocks, a lot of the reasons why I reduce my positions, is I don't like the fundamentals. I don't like where the business is going. I don't like their dividend policies. In the last two here, we have IBM and AT&T. I think these two are at a huge risk of cutting their dividend. I don't really like where their business fundamentals are going. But with Altria, one thing that I've mentioned in past videos is that their business is doing okay considering the shutdown. But that said, their dividend is so high, it's hard to look at it and not get scared. And I was proven wrong that not only will they maintain their dividend, but they will be raising their dividend. They will be raising their dividend another 2.4%. So not only are they going to be keeping their dividend of about 8-ish%, they're going to be raising it again in this recession. And I'm sure if we have another small dip in share price, this will get back up to a 10% yielding stock. You know, they say that the S&P 500 goes up about 9.8% a year on average. This dividend by itself, even if the share price never budged, if it stayed at $42 a share, you're nearly matching the market just off of its dividend, which I'm sure will get raised next year as well. So that is a great beat there by Altria. And let's go ahead and finish out this video by going over a comment that Omar B left. Awesome video as always. Oh, which by the way, Omar, he is a guy that is one of my first subscribers. My subscribers have been with me for a long time, and I remember a lot of the names for some of the first 100, 200, 300 subscribers that started with me, and Omar was one of the first guys, so shout out to him. Awesome video as always. How much and how frequently are you investing into your portfolio? And is this a constant amount, or will you increase the amount depending on factors such as your income or stock market performance? So let me give just a basic idea of what's going on now. Remember these words that I'm about to tell you. Starting next week, starting Monday, this channel and my portfolio is about to take off. I am about to invest a lot more than what I'm doing. If we go to my activity here, we sort by deposits and withdrawals, and then we get rid of this. And then you see that I invest about $25 a week. Sometimes we have a really big red day. Sometimes I'll throw in an extra $25 or if I can afford it. But basically $25 a week is all that I'm doing. Well, starting Monday, I'm bumping that up to $100 a week. So this $3,000 portfolio is very quickly going to become a $4,000, a $5,000, a $10,000 portfolio. Not to mention that I have a pretty good cash pile that I'm about to move over, that I have been saving up, that I will be moving over in about the next month or two. But that said, I don't really like to focus so much on where the market's at. I like to invest steady, and maybe one day when I graduate college 2 years from now, I will invest well over $1,000 a month. But thank you, Omar, for watching. Thank you guys, all of you that are watching my videos. I talked about my channel taking off as well, not just my portfolio. And just like with all of my videos, I disclose everything. We are now up to 1,238 subscribers, and it was less than 2 weeks ago that I hit 1,000. Less than 2 weeks ago. So this portfolio and this channel is beginning to take off. And I won't hide it either. I have 1 week worth of revenue, and I've made $54 from revenue. Every single dime that I make from this portfolio, a piece of it will be set aside for taxes, but outside of that, every single dollar that I make from YouTube, every ad that you guys watch will go back into this portfolio. We'll grow it quicker, we'll grow my channel, and we'll reinvest back into the business. So thank you guys so much for watching if you made it all the way to the end. Like I said, if you're new to the channel and you're not familiar with me, go ahead and support me by checking out the description. You can either sign up through M1 Finance, I have credit card referrals, I have other brokerage referrals, I have services that I offer, I have information about me, and go ahead and subscribe to the channel if you're new. And if you sign up for M1 Finance, be the 19th, be the 20th person that signs up for this referral link, because I would love to get that $10 and I would love to get you started and get that $10 boost for getting you started with this brokerage. So if you're new, guys, go ahead and subscribe, and thank you guys for watching all the way to the end. If you have any comments for me, go ahead and leave them down in the comment section. I'll answer any questions you might have about me, about my portfolio, about my investments. I'd love to answer any questions you guys might have. Thank you guys for watching, and I'll see you next time.